The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how you going?
Very good, James, and great to bridge the gap between Sydney and Melbourne again.
Absolutely. All right, well, this week we've got a big edition. We're going to hack our way through the maze of pain that Optus finds itself in. We're going to try to make sense of the fear and loathing on global markets, and we're going to look ahead to the RBA's big call next week. But first, Tony, I want to go back to our last week's episode. We talked a little bit about the mess at AGL Energy, and there's been no shortage of action on that front in the last few days. On Wednesday night, Mike Cannon-Brookes, who you'll remember owns 11% of the company, he put forward no less than 4 board members, including Kerry Schott and Professor John Pollers, who he wants to see on the AGL board. Now, 4 board members is a fair ask for someone who's only got 11% of the company. Is Mike Cannon-Brookes going for a little bit more than he deserves here?
Yes, I think he is, James. I think he's trying to get control of the company by having control of the majority of seats on the board. We know that he's very much in favour of Miles George, and he's put forward 4 independent directors who are nominated by him. So if there was a vote, that'd be 5-4, although the key vote would be the new CEO who's yet to be appointed. So that would be taking control of a company without paying a premium, which is something Kerry Stokes has done, and Gary Weiss is a master at it. So it's not unusual in that sense, but it's certainly not in the interest of minority shareholders.
Do you think the minority shareholders who supported Mike Cannon-Brookes when he stepped up to block AGL's plan to split itself in two, to demerge part of its business, do you think they quite knew what they were getting into here, that they quite expected 4 directors to be put up by Cannon-Brookes and his team?
No, I don't think so, because originally this was a full-blown takeover offer in partnership with Brookfield, but he's definitely having his way, because the strategic review announced on Thursday basically is virtually everything that Mike Cannon-Brookes wanted. Tell
us a little bit about that, Tony. I guess the headline here is that AGL is promising to shut its big coal-fired power plant, Loy Yang A, down in Victoria, going to shut it 10 years earlier than planned. On the face of it, that's good for the environment, but is there more to this than meets the eye?
Well, the big unknown, James, is their promise to invest $20 billion by 2036. So they want to produce an additional 12 gigawatts of power from renewables. That basically boils down to 5 gigawatts by 2030, so that'd cost about 8 or 9 billion, and then the balance of the money would be paid after that to get the remainder. Now, the issue there is that we don't know how this will be, which sources. They've named every possible source of financing in the world to get there, but I think I wonder, do you think they're going to have to go and raise equity?
Oh, I mean, $20 billion is an awful lot of money. You would have to think that some part of that is going to come from existing shareholders in the form of a capital raising. But if you're an investor looking at this business now, I mean, it's good for the environment that they're promising to shut these coal-fired power stations 10 years earlier. The problem for AGL is that's where most of their earnings come from. So you do, as an investor, look at this and go, hang on, we're losing most of our investors, and now you're potentially asking me to invest in a capital raising. If I'm an AGL investor, I want a pretty big discount to back that capital raising, don't I? Surely.
Exactly. That discount could be massive. I mean, I put to senior sources in the company that they were blowing up their earnings engine, and the response I got was that at $70 to $80 a megawatt hour, a renewable energy plant is far more profitable than a coal-fired plant. There's no maintenance costs, there's no coal costs. So we're actually going to see, this is a living example of transition that could fall either way for the shareholders of AGL.
Yeah. And it's a great point, Tony. It's a living example of transition for the country too. I mean, here is the quandary encapsulated in one company. You need to invest huge amounts of money up front before sort of racing against the clock before these coal-fired power stations are closed down. I mean, this is the problem for that Australia faces. What happens if we're not ready in 10 years and one of the biggest coal-fired power stations shuts its doors? Does the government have to step in? I mean, there's all sorts of questions here, isn't there?
It's possible, James, that some of these coal-fired power stations may end up in the ownership of the government. I've thought very interesting how Queensland came out earlier in the week. $60 billion they're investing over 10 years to complete an energy transition in that state. You add it all up, there's $100 billion of investment that's going to happen by 2030. And each of these entities, whether they're government-owned or private, are going to be all doing the same thing, building renewable power, whether it's pumped hydro, solar, wind, and they're all going to be competing for the same resources. Yeah. This is potentially a huge bottleneck that will just blow out all CapEx modelling that is in every potential company's vision at the moment.
Yeah, we're talking about getting inflation, inflation running sort of up towards 7-8% at the moment. I mean, the inflation around the energy transition is going to be extraordinary. Think of everyone competing for copper, everyone competing for steel, everyone competing for labour. And it's not just $100 billion worth of projects in Australia. These projects need to happen all over the world to make this global energy transition we need. So, I mean, this is an extraordinary push that clearly it needs to happen, but it's going to be very expensive and it's going to be really difficult to pull off from a sort of operational standpoint. Just getting the stuff to do it and the people to do it is going to be some sort of challenge.
And I think there's huge pressure on Chris Bowen. He's taken over the idea of a mechanism to get the firming capacity for renewables from the Energy Security Board. And we have heard nothing since that happened in August. Yeah.
Well, that's the next challenge. All right, Tony. Well, let's go from one big mess to a mess that's even bigger. This is the yarn that just keeps getting bigger and bigger through the week, and that's the hack at Optus, which appears to have compromised something like 9 million personal records of Australians. And this is one with a lot. We've got the government throwing bombs from the sidelines. We've got consumers unsure of what's exactly happened to them. We've got a company that's, really scrambling to figure out a way through this mess. You've written on this extensively, Tony, this week. Do you have a good sense of what went wrong here, or is that still the $64 question?
Yes, I don't think really we're going to know until the Australian Federal Police complete their investigation. And certainly the AFP have told Optus not to say certain things. I think they were disappointed when the company said that there was actually no ransom demand and no ransom paid, I'm sorry. So, but yeah, look, I think every CEO in Australia is saying, there but for the grace of God go me, because hacking tools these days are so sophisticated that you can just get them on the dark web, and there's also nation states. So I think every CEO is probably at the moment checking all of their security measures and checks. But the one question I really wonder about is, why have the crisis communications been so bad? I mean, what do you think it's strange to have so much different information being dribbled out over time?
I think this is part of the problem with this cyber space. Everything is so muddy. I mean, you just mentioned the idea of paying the ransom. I did a story a little while back. There's actually no legal position on that. If you look in some laws, it's illegal to pay a ransom because it falls foul of terrorism and funding crime. So we don't, but that's never really been tested in court. So that's one murky part. Yes, okay, the AFP and I believe the FBI have been dragged into this, but what's the last big hacking criminal case that you saw come before a court really anywhere in the world? It just doesn't happen. So I'm not sure anyone's going to be brought to account or brought to book over this. And then we've got the question that I think you've addressed this week of what's Optus need to do and spend to put this right. I mean, the question of whether they're going to have to pay for people's licenses and passports and then maybe class actions and other damages. Do you have a sense of what this might cost?
Well, when this first broke last week, my first column I wrote was about the costs, and I figured out it was probably about $1 billion. I reckon a week later, it must be getting up to $2 billion. If they're going to have to pay for new licenses, new passports, credit monitoring, we've now, of course, seen that there was 34,000 Medicare numbers. Some were expired, others weren't. There may be compensation. There's 2 class action firms circling. Those things tend to get settled on the footsteps of the court. I mean, finally, I think the investors in Singapore Telecommunications, or Singtel, have recognised this. The stock's down about 5% now since this happened. So I suppose a lot of the questions now are about the CEO and what responsibility she might bear, or will she become the fall guy for slack security measures? What do you reckon?
I mean, well, it seems very, I think she's probably done okay in a very difficult crisis where there's been bombs thrown by the government and, the cops and class action lawyers. It is a moving feast. So she's handling this relatively well, Kelly Bayer Rosmarin. But you're right. I mean, as the costs of this mount, I think it's probably important that Singtel backs her through the crisis part. But as we get through the crisis eases and we start to figure out what's happening, I think it's going to very much depend on as the government has suggested, is this a basic hack that Optus has sort of left a door or a window open to occur, or is this the work of a sophisticated villain, as Optus says? I don't know. Do you think she can keep her job, Tony?
Well, hopefully she's learned one thing through this, and that is you can never win an argument against a federal minister of the government. And of course, the argument between Kelly Bayer Rosmarin and the minister, Claire O'Neill, was over the attack itself. And the minister said it was a basic attack and should never have been allowed to get through. And of course, the Optus CEO says it was a very sophisticated attack that got through layers of encryption. As I say, you can't win that argument. We'll have to wait for the federal police to come up with the answers. As for the minister, I think she's struggling. She's finding that a lot of the legislation that was meant to help her to respond to things like this is inadequate or just not fit for purpose. So I think this is actually a turning point in Australia's history of cyber protection and data protection, and we're going to find bigger fines, hopefully much better fundamental protection of people's data, and also better communication of what actually has gone out to the dark web.
And hopefully a better model for crisis response. A few weeks ago, we wrote about how the suggestion's been put for a sort of takeovers panel style cyber panel that could respond and help a organisation that gets hit by a big attack. Form like the takeovers panel, form within a couple of hours and help guide a company or an organisation through this. You'd have to say that the Optus case study suggests that might not be such a bad idea to consider pretty quickly after this. Well, Tony, Optus has been all-encompassing this week, but it hasn't been enough to take our eye off what has been an absolutely crazy week on markets around the world. Now, we saw Wall Street hit its lowest point for the year on fresh concerns that the Federal Reserve, which is, of course, is the US version of the Reserve Bank of Australia, will basically push the US and vast parts of the world into recession by continuing to raise rates to fight inflation. But then the good people in Old Blighty in the UK have had an exceptionally crazy week of their own. This all started on Sunday when the UK government announced tax cuts. The bond markets went absolutely berserk at this idea, basically worried that this would increase inflation, force the Bank of England to raise rates further and push the British economy into a very, very, very deep recession. And then, Tony, overnight we had this extraordinary move by the Bank of England to intervene in bond markets and bail out pension funds. What was going on here?
Well, this crisis in the UK is all of its own making. Basically the treasurer there, Kwasi Kwarteng, has taken, I suppose, actions that are meant to help households by introducing a fiscal stimulus that will blow out the amount of bonds that have to be issued. And this deliberate attempt, I suppose, to help households has turned into a foreign currency crisis. And I mean, in some ways it makes sense to use fiscal policy to help people under pressure because of soaring energy prices. But it's completely the opposite of what the Bank of England itself was trying to do. So it's basically gone in to defend the currency and the bond market to stop. I think the Financial Times had a great story about the impact this is having on UK pensions.
Yeah.
So to me, it's like this is all the chickens have come home to roost from Brexit. This is a country that decided to cut itself off from a market of 450 million people, and its economy has suffered badly from that. And I'm not sure you can fix it by just spending billions in a way that threatens the stability of financial system.
Absolutely not. I mean, this UK pension bailout, which occurred on Wednesday night, is quite extraordinary. So basically, pension funds had been using hedging to smooth out the impact of inflation. This was fine while inflation was low and bond yields were pretty static. But what we've seen in the last 5 days since this tax cut was announced was bonds have risen basically a year's worth of increase in 5 days, and that's caught these pension funds out. They're having to commit more liquidity to meet the margin loans they've taken out on this inflation protection. To do that, they're selling long-dated bonds, and that's put that market under pressure. And so the Bank of England's had to step in to ensure financial stability. And what's the Bank of England doing? They're going back to buying bonds, which was the problem that got us here in the first place. It's going to be a very short-term campaign. But, Tony, this feels like one of those moments where the speed with which inflation's come back, the speed with which interest rates are rising, it's starting to break things. There's these unintended consequences in little corners of the market. I mean, you could have given us 100 guesses and we wouldn't have guessed that, inflation hedging by UK pension funds would be a problem. But here we are. I mean, this is the problem when rates are rising so quickly, isn't it? I mean, you've written about the US dollar this week. That's another example of the sort of ripple effects that higher rates and higher inflation have.
Yeah, the US dollar has become the best safe haven in the world, and that happens whenever the world's in crisis. It's not gold. It's the US dollar. Don't worry about the fact that there's 25% more US dollar on issue than there was a few years ago because they just keep pumping out more money. But the point is, when the US dollar is this high, and Mike Wilson at Morgan Stanley made this point, it often ends in a crisis of some proportions. And now his point is that, yes, well, it'll bring the bear market to an end faster because we'll have the momentum to get there. But the strong US dollar, of course, is great for Australian companies that have US dollar earnings because they're being reported they're going to come through in Australian dollar dividends that are much higher. But for US companies, it's a drag on their earnings, and I think Wilson said it'd be down about 10% in the fourth quarter. So there's a number of different headwinds. But one thing that's come out of all this is that the macro hedge funds are loving it. They're back to their opportunities that they can see all around the world. First, they had the Russian-Ukraine invasion, which caused enormous upheaval. And now we have this constant volatility in bond markets. The US dollar is also causing problems, of course, in Asian economies where stock markets there are down 35%. It's got all sorts of flow-on effects.
That's a really good point, Tony. I mean, this is the problem for share markets, which, obviously they've fallen a lot this year, particularly in the US, slightly less so in Australia. But the pressure is going to continue to mount in two ways. The first is that, we're now staring into a global recession, so that's not good for company earnings. But the second thing is that profit margins are still near record highs right around the world, so they have to come down. And as profit margins come down, as actual earnings fall, that should put more pressure on share prices. So this is a tough moment for equity investors. And there had been a sense, I mean, only back in June and July, there had been this sense that we might be through the worst of it. But it doesn't feel like that anymore, does it, Tony? It feels like a pretty rocky road to the end of the year now.
It does. And you know, the thing that really intrigues me, James, and I've got to stop saying I'm intrigued on this podcast every week, but the really intriguing thing is private unlisted assets. We just haven't seen any movement. I mean, why is it that private equity is somehow immune to all of the crash in prices of assets on global listed exchanges? And this is, very important to us as a country, because 15 to 20% of the assets in our super funds are unlisted assets. Now, there's a firm called Cambridge that does a lot of the valuations of these private equity assets. And from what I understand, they do a smoothing process, and that alleviates the problem of writing stuff down. But surely there has to be a reckoning at some point. And I looked at the returns of Host Plus, our number one performing super fund, which had a big stake in Canva. And guess what? Their returns for 6 months in one of their balanced funds is down 6%. That's right. Very different to the 1% for the full year to June. It's an interesting way in which that point in time tells you that perhaps some of their unlisted assets have fallen in value.
Yeah, so there could be a bit of a reckoning coming for super fund members whose returns looked okay for 2021, 22, but maybe that was an earlier snapshot and the pain's coming.
Yes, possibly. And
now, Tony,
go on.
You have been pretty optimistic on this podcast in our first few weeks, hoping we could dodge the global recession. How are you feeling about that now?
Oh, James, the more I read, my optimism is sort of crashing on the rocks of reality, because there was some interesting, I got a note there from McKinsey that Alan Blinder of Princeton University said that of the 11 rounds of Fed tightening since 1965, one of them lasted 3 years, and most of them ended in a recession. There's some more analysis from someone at Capital Economics. 81 G7 tightening cycles since 1960 reveal that the hikes of around this magnitude have reliably been followed by recessions. So it's hard for me to hold on to the optimism in the face of all this. What about you?
Well, I read something interesting from Stanley Druckenmiller the other today, who was he was working with George Soros when they broke the pound famously all those years ago, and obviously had some interesting things to say about the pound's recent travails. But he did have one sort of note of optimism, and that's that he's open to something good happening. That there could be some sort of we've been through a lot of bad news in the last few years with pandemics and that sort of thing, and he remains open to something great happening and catalysing a bit of a rally. So I thought if, one of the great investors of Wall Street can be upbeat, maybe we should be too. But I'm with you, I got to admit. It's a crazy world out there at the moment. Great for journalists, very tough for investors.
Yeah, I mean, look, the only thing I can hang on to is that this economist at Capital Economics said that the technical definition of a global recession at the IMF is growth rate of less than 2.5%. So even if it gets down to 2, the global economy is still growing.
Yeah, fair enough. All right, Tony, we're going to come back after the break with the big event for next week. That's the RBA's decision on interest rates, and I want to hear where you think they're going to go. All right, Tony, we're back and we've got a very, very important thing to look forward to next week, which is the RBA's big interest rate decision. Now, obviously, pressure is building around the world. We've seen the Fed and countless other central banks raise rates in the last couple of weeks in the face of surging inflation. The RBA's got some strong inflation numbers and some strong retail sales numbers of its own to look at. Which way do you think the central bank goes here? Which way does Governor Philip Lowe decide to go? Does he go half a percentage point rise, or does he dial things back just a touch by going a quarter of a percentage point rise next Tuesday?
Well, James, I think the answer's pretty clear that after those inflation numbers, which were at a 7-year high, and the retail sales, which 3 months annualised on a seasonally adjusted basis were up 10%, came out earlier in the week, I think it's going to be a 50 basis point rise that's coming down the pipeline from Martin Place.
Yeah, I think you're probably right. I mean, I think there's a case for the RBA, and Phil Lowe's obviously been out in the last few months making this point that there will eventually be a time when he's got to slow down. I think the data suggests that the economy is just still running too hot. Those retail sales figures are fascinating to me. I mean, people must be digging into savings that they built up during the COVID period. I mean, the round figure was about $200 billion of government stimulus that was put into people's bank accounts. So they must be digging into that. But consumers show no hesitation about continuing to spend, and I don't think the RBA can ignore that. I guess if there's one caveat, Tony, that the RBA will be watching pretty closely, that's house prices. We get the next monthly survey on Monday. It's not going to be good news. The falls are starting to accelerate. Will falls in house prices start to play on the RBA's mind, do you think?
I think that's what they want to happen, James. I mean, on the one hand, it helps housing affordability, but also it's a sign that it's starting to really cause some pain for consumers. As you know, the economists are all raising their terminal rates for how high the RBA will go, and I think that the latest I saw from Nomura is 3.85% by February next year. I mean, this is going to really push up, especially those $500 billion worth of mortgages that are going to flow off old fixed rates onto new fixed rates in 2023. It's really going to start to cut into people's household budgets and their availability of money. So yeah, if house prices are down again, I think the RBA will be happy.
Yeah. I'm starting to wonder whether the RBA might be looking at this market and thinking, things are going to get a bit dicey here. We've just got so much household debt, and the world seems to be turning so bad so quickly. I mean, we've seen the Treasurer Jim Chalmers call the world a pretty dangerous place in the last few days. I was starting to wonder whether the RBA might be sniffing the breeze and pulling back, seeing if they can engineer that soft landing. But let's see. They've probably got a couple, we've got a November meeting and a December meeting where they could rein it in. And I think you're probably right. They'll go 50 basis points, half a percentage point on Tuesday. All right. Well, Tony, we've got a question from our audience again. We encourage your questions. Send us an email at chanticleer@afr.com and pose us a question. This week's one comes from Simon, who asks a cracking question. What entry-level job should my teenager do to get them ready for future job markets? Now, I don't know if what it's like around your part of Sydney, Tony, but my gosh, there is a lot of businesses advertising for junior staff and help wanted. I mean, even Macca's has a national advertising campaign just based on recruiting kids at the minute. So kids have got plenty of choice. What way should Simon steer his young people?
Well, one of my nephews who is now working for one of the big professional accounting firms started out his career at McDonald's. Yeah. It's quite a disciplined place to work. They have very good managers and usually reasonably flexible working hours, and they pay more than the minimum wage. But I mean, there are so many jobs that you can do that just give you a taste for work. I was talking to Solomon Lew from Premier Investments, and he was telling me one of the reasons he thinks his company's retail sales have done reasonably well is because people who work in hospitality have been getting pay rises of $10 to $15 an hour. And this is because of the shortage of workers. So there's some pretty well-paid, unskilled jobs out there that might be a place to start. What do you think? Have you got any experience of relatives, friends?
Yeah, look, I think there's lots of good opportunities out there. Bunnings is one that I've always had some people I know work there, and it seems to be a pretty good gig, pretty well paid, and you learn a few life skills as well, how to organise your house a little bit, which is not a bad thing. And
what was your first job as a young nipper?
My first job was in a bottle shop, Tony. It was actually good fun. I mean, I'm a bit like you though. I think the important thing is not to worry too much about, the future career path. It's to get out there and do work. Understand what it's like, how people spend money and what annoys people and what pleases them. It just gives you good life skills to understand different situations. I mean, the different range of characters you'd have come through the bottle shop at various times, from people who knew nothing about booze to people who, were regular customers and tradies and executives. You meet all types of people, and I think that's the good thing about getting out there and doing any job. It's just meeting people and getting into the workforce. You've got to start somewhere.
And what about this weekend's Rugby League Grand Final? What's your call on that? Is it the Penrith Panthers or the Parramatta Eels?
I watched the Panthers last week, and they look pretty hard to stop. But look, it's a bit out of my experience range. I enjoyed last week's AFL Grand Final. Your Swans were pretty terrible, but you're in the right state, Tony. Eels or the Panthers?
Look, I'm going for the underdogs, which are the Eels. The Penrith Panthers are just a phenomenal team. So that's look. I grew up in the eastern suburbs of Sydney, so my team for Chanticleer, I think it's very appropriate. The Roosters, but they're not there.
Course.
So yeah, let's see how the Eels go. And although I am wary, given that I tipped the Swans last week.
Yes. Well, Tony, thank you for another great discussion, and enjoy your Monday after the grand final up in Sydney. Don't worry, the Chanticleer column will continue with an eye on markets over the weekend too.
Thanks, James.
If you like the podcast and want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lapfan.
The Australian Financial Review.